Hello to everyone. Today I am here with the introduction to Managerial Finance Part 2. If you are interested to have update videos on banking and finance related topics, please do subscribe my channel. Today we are going to cover the fundamental finance principle. Secondly, mirroring value creation with net present value. What do mean by destroy value? How long a firm fund a project? How project can successfully create value. Fundamental finance principle, we recall the key questions before making a business decision. That is, will the decision create value? If the decision is not creating the value, so there is no use of the decision. The question can be answered based on the fundamental finance principle. A business proposal such as a new investment, the acquisition of another company, a restructuring plan will create value only if the present value of the future stream of net cash flow exceed the initial cash outflow. It means if the net present value is positive, the project may be viable. If it's not positive, it's not viable. Because in case a negative net present value means you are not having the return according to your expected return. For example, if the firm's owners are indifferent to whether they receive a cash dividend of rupees 100 million today or to gain an expected cash dividend of 115 million next year, then 100 million is the present value of 115 million expected next year. So it can give you the clarity about the concept only. Mirroring value creation with the net present value, the difference between a proposed present value and the initial cash outlay. Initial cash outlay means the total investment you have invested within the project till it comes operational. Required to implement the proposal is the proposal's net present value. Net present value that is equal to initial outlay. It's negative because these all is a part of your outflow. Present value of the future net cash outflows. It can be projected, or if you are in the business, you may review your business on the basis of net present value of the annually cash flows as well in order to assess the actual return from the business. If net present value is positive, then the project is accepted. Means you are getting return above your expected returns. What do you mean by the destroy value? A business proposal create value if its net present value is positive and destroy value if its net present value is negative. Means your return is less than your expected return. The more value is negative, the lower the return you may have. The proposal net present value go to the investor, shareholders who own or undertake the project. The shareholders can sell their equity stake in the company that announced more than they could sell it for if the project were not undertaken, and the difference should be equal to the project's net present value. How project can successfully create value? The firm's ability to identify the project and the market expectations that the firm will carry out the project successfully create an increase in the firm's value and the wealth of its shareholders, because the market price of the shareholders varies the wealth of shareholders. If the shares of the firm are listed and traded on the stock exchange, the market value of the firm should rise by an amount equal to the project net present value, and the market agrees with the firm's analysis of the project's profitability. Now, the market value have a direct relation with the book value as well. When your equity increases by adding back a part of the profit in the shape of reserves or retained earnings, definitely its market book value increases, and that have a direct relation with the market value of the stocks as well. There are other factors too, some business decisions that you might planning to take in terms of bringing new modern machinery, bringing effective management, bringing any new products. So they also increase the market value of your stocks. The role played by the financial market in the process of value creation. So in this way, the financial markets play their role for the value creation of your company as well. How project can successfully create value? Other factor, only cash matter. The fundamental finance principle requires the initial investment need to undertake a proposal, as well as the stream of net future benefits in the shape of net cash flows is expected to generate to myriad in cash. The investor who are financing the proposal, the firm shareholders, and debt holders having investing cash in the firm and are thus interested only in the cash return. There is no doubt in it. Cash benefits of a project must not be confused with the increase in the firm's net profit expected from the project, because profit are counting measures of the benefit, not of cash return. Cash returns are always in the shape of dividends, profit, etc. So, accounting values are in the shape of, you can say, capital gains, etc. Here we have an shape, only cash matters to the investors. First of all, investors include shareholders who are the owners, debt holders, that invest the money within the business. Investors provide the initial cash flows required to finance the proposal. Now, shareholders are the investors provide the initial cash. Or it may also include a part of the lenders. After having this cash, you also need a financing from the outside that used to be provided by the debt holders. You have a business proposal. The proposal generates future cash returns to the investor. So you make a thorough analysis by calculating the projected cash flows as well. So on the basis of those projected cash flows, you apply the financial modeling techniques to check the viability of the business. Thereafter, you used to take the decision either this project can successfully create value for the shareholders or not. Thank you very much. See you again with the upcoming video on the same topic very soon.